Hi everyone, this is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is the best-selling author of Currency Wars, The Death of Money, The New Case for Gold, and his newest book, The Road to Ruin. He is also the editor of the financial newsletter Strategic Intelligence. Jim Rickards, thank you for joining me again.
Great to be with you, Jason.
Now, Jim, I want to ask you a question that I haven't heard a lot of the talking heads discussing the Federal Reserve's move talk about. Who could even afford to buy $100 billion or more of US Treasuries if the Federal Reserve wants to reduce its balance sheet?
It depends how they do it. The Fed is not going to sell any securities. They are reducing their balance sheet effective October 1st. They call this balance sheet normalization. I call it, and others call it quantitative tightening, or QT. It's the flip side of quantitative easing, or the famous QE. You know, we had QE1, QE2, QE3. So the way it works when you're growing the balance sheet is the Fed wants to print money, and so they just call up one of the primary dealers and buy government securities. And so they'll call Goldman Sachs or Citibank or JP Morgan or one of the big dealers and say, you know, offer me some 10-year notes, and they'll make an offer, and the Fed will say done, and then Goldman Sachs, let's say, will deliver the 10-year notes, and then the Fed pays for them, but they pay for them with money that comes out of thin air. So that's just, they credit Goldman Sachs's bank account, and that money comes out of nowhere, and that's how the Fed creates money. Well, the same thing is true in reverse. If you want to reduce the money supply, you just sell bonds back to the dealers pay you money, and the money disappears. When the money comes into the Fed, it literally disappears, and that's how they reduce the money supply and tighten monetary conditions. So now the Fed is trying to what they call normalize their balance sheet. You know, their balance sheet was about $800 billion at the beginning of the crisis in 2008. They took it as high as a little over $4.3 trillion by late 2014 at the end of the taper, and did all that with printed money, of course. And now they want to reduce it. They printed $3.5 trillion of new money. Well, there are two ways to do that. One is you could sell the bonds back, which we talked about, and that kind of gets to your question, Jason. If they try to dump $1 trillion worth of bonds, who's going to buy them? But they're not. That's not what they're going to do. They're not going to sell any bonds. What they do is when you hold a bond and it matures, the Treasury just sends you the money. You don't have to sell anything. So, for example, if I bought a 5-year Treasury note 5 years ago and I hold it today and it matures, the Treasury is just going to send the money to my bank account and the bond goes away. So I don't have to sell the bond. I just have to wait until it runs off and I get paid at maturity. So that's what the Fed's going to do. And by the way, that's been happening all along. You know, you go back to 2009, let's say, during QE1, the Fed might have bought a 5-year note at that time, but by 2014 that matured, and the Treasury sent the Fed the money. But what the Fed did then is they got the money and they went out and bought another bond. In other words, they took the maturing assets and they rolled them over into a new bond, or actually at that time they were still expanding the money supply. And that's the way to maintain the balance sheet. So while the old bonds run off, you go out and buy new bonds and you keep the balance sheet the same. But now what they're going to do is when the bonds mature, they're not going to buy new ones. So it is a form of monetary tightening. It will have an impact on the Treasury market, but it's not quite the same as dumping $1 trillion worth of Treasury bonds. All you have to do is sit there and do nothing and let them run off. So the question is, pardon me, what is the tempo or the rate at which they will run them off? And there the Fed has already said that they're going to start low, about $20 billion a month, $10 billion of treasuries, $10 billion of mortgages. So that amount will, as it matures, they will not buy new ones. But all the rest of them, the other, remaining, as I say, 4.3 trillion, when those mature, they will keep buying new ones, but they'll just reduce the amount of new ones that they buy. They're going to increase, it's kind of a funny jargon, they're going to increase the amount by which they reduce the balance sheet, meaning that right now they're not going to roll over 20 billion a month. They're going to increase that 10 billion every quarter until they get to a total of 500 billion a year. Sorry, actually 600 billion a year, 50 billion a month, which comes to 600 billion a year, probably by around the end of 2018. So, but that's a lot. You run off your balance sheet $600 billion a year. That's the equivalent to at least one, maybe two rate hikes. The Fed would have us believe that this will just run on background, as they put it. pay no attention. It won't be used as a policy tool. It won't have much impact on the economy. I think that's all nonsense. I mean, maybe they don't intend to use it as a policy tool, but it will have an impact on the economy. It's the same as raising rates. They're raising into weakness. They've been doing that all along. So I think the Fed underestimates the extent to which this tightening will affect the economy, but they're not actually going to dump or sell any bonds. They're just going to let them run off and let the money disappear.
And we all know the Federal Reserve's track record for their poor predictive models. Wall Street also has a poor track record for predictive modeling as well. But, with Operation Twist, Jim, didn't the Fed on a lot of their bond purchases, didn't they switch from those, you use 5-year treasuries, didn't they switch a lot of their purchases from shorter duration into 30-year longer duration? So don't they have a lot of longer duration bonds on their balance sheet now?
They have some, but it's mostly centered in the intermediate sector, the 5 to 10-year sector. And a lot of those bonds were bought 3, 4, 5 years ago. So they have been shortening out the maturity. So, say if I bought a 5-year bond in 2014, a 5-year note in 2014 that matures in 2019, it's only 2 years to maturity. So it effectively kind of walks and talks like a 2-year note at this point. So they never did buy a lot of 30-year bonds. They have some. But bear in mind, the Fed used to have everything at the short end. They used to have 30-day paper, 60-day paper, 120-day paper, and so forth. And so they went out into the intermediate term sector, buying 10-year notes very heavily during QE2 and QE3 back in 2011, 2012, 2013. But, they were buying those 10-year notes 6, 7 years ago. So effectively, those old ones are down to, kind of 3, 4 years to maturity. So, and this runoff we described is going to play out over about 3 years. So they've got the timing about right. I think they've come up with a way of managing the reduction of the balance sheet that's not highly disruptive and does not require selling a lot of bonds, and they have shortened up the maturity structures. That's the good news. The bad news is they're underestimating the impact of the tightening in what is already a weak economy. That's one reason, by the way, they're not going to raise rates in December. The market expects that they will. The Fed Fund futures have an implied probability over 70%. I put it closer to 20%. I don't see how the Fed can raise rates in December, but that's partly a recognition of the fact that this balance sheet normalization is a form of tightening as it is.
And when you look at the collective central bank purchases, whether it's the Bank of Japan, the European Central Bank, the Bank of England, along with the Federal Reserve, they've created over 18 trillion of money and credit out of thin air. The Bank of Japan and the European Central Bank have actually done a lot more QE than the Federal Reserve the last few years, and their balance sheets are larger than the Fed. Do you think the Fed doesn't care at this point then that they're increasing the probability of asset prices having a large correction by reducing their balance sheet?
Well, I think they care, but they've got other things to care about as well. For example, so one concern, it's probably at the bottom of the pile, is popping asset bubbles. The Fed has a strange view of asset bubbles. That, first of all, they don't see them. I see them and you see them, but the Fed doesn't. Secondly, even if they were convinced that there was a bubble, they're not sure it's their job to go ahead and pop the bubble. They would say, well, let the bubble pop on its own and we'll clean up the mess. That didn't work out too well in 2008, but that's a view that they hold to. It goes all the way back to the Great Depression when the Fed tried to deflate the stock market in 1927 and ended up causing a crash which led to the Great Depression. So the Fed takes the view that they shouldn't be in the business of popping bubbles if they could even see them, which they usually don't. But that aside, they're on another mission, and it's one that they haven't had to do at all, I think, in the entire history of the Fed, which is they're raising rates and reducing the balance sheet, not because the economy is strong, not because they're trying to cool down inflation or get ahead of an overly strong expansion, but because they're getting ready for the next recession. Remember, in the last financial panic, it was both a recession and a financial panic. They're two different things, but we had a business cycle recession and a financial panic that probably reinforced each other in 2007, 2008. So what did the Fed do? They cut interest rates to 0 and then held them there for 6 years, and they expanded the balance sheet to 4.3 trillion and held that there for a number of years since the end of the taper. Now they're saying, gee, what if we had a recession tomorrow? How could we cut interest rates? It takes about 300 to 400 basis points of interest rate cuts to get the United States out of a recession. How do you cut interest rates 300 basis points when you're only at 100 basis points? Well, the answer is you can't. And then what happens if you cut interest rates and you still don't get out of the recession? What do you do then? Well, the answer is you go to quantitative easing, printing money. Well, how do you print money when you've already printed 4.3 trillion? Are you going to take the balance sheet to 5 trillion, 6 trillion? How do you do that without destroying confidence in the dollar, crossing kind of an invisible confidence threshold? So what the Fed is saying is, well, we can't run the same playbook we did in 2008 of cutting rates and expanding the balance sheet because we've never normalized. Rates are still low. The balance sheet is still bloated. We never got back to normal. Therefore, we have no capacity to use those policy tools. So what they're trying to do, they're trying to get interest rates up to around 3.25%. They're trying to get the balance sheet back down to maybe $2 trillion so that when we have a recession or a financial panic, they go, aha, no problem. We can cut interest rates 300 basis points, and we can expand the balance sheet $2 trillion, and we can use rate cuts and zero interest rate policy and QE to get out of the recession the same way we did in 2008. But here's the trick. They're not there yet. They're only at about 1% on interest rates, and they're still over $4 trillion on the balance sheet. So how do you normalize rates and balance sheet without causing the recession that you're preparing to cure? In other words, they're getting ready for a recession, but in the course of getting ready, they might actually cause the recession. In fact, I think that's highly likely. I don't think the Fed's going to be able to do it. I think they think they can. They've already started. They got interest rates up to 1%. They have plans to raise them more. I don't think they're going to be able to in December. I'm doubtful they're going to be able to in next March, March 2018. But we'll see. But it's certainly their intention to raise rates whenever they can. And it is absolutely their intention to reduce the balance sheet. So they're trying to get their ducks in a row for the next recession, but my estimate is that the recession is going to come or a financial panic is going to come before they can get to that position, and therefore they're going to run out of policy room to deal with it, and so will the rest of the world. As you mentioned, Bank of Japan, Bank of England, People's Bank of China, they're all in the same situation. European Central Bank, they're all in the same situation. They're not going to be able to normalize rates and the balance sheet before the next either panic or recession, at which point they're going to run out of policy tools, and my estimate, they'll have to return to the IMF for liquidity.
Yeah, I don't think they're going to be successful doing it. I think, the true insiders like Stanley Fischer see the writing on the wall, and I think that's why, he cited health reasons. But I think, one of the reasons he left is he also doesn't want to be blamed for the crash, so he's getting out while he still can. And I think, early next year, Janet Yellen and potentially Mario Draghi will also want to leave too before the next financial crisis.
Yeah, I think, well, Janet Yellen's done at the end of January. Her term is up. She's still on the Board of Governors, but her term as chairman is up, and it would be shocking for her to stay on the Board of Governors, not, just as a regular governor, not as the chairperson. So I expect she'll be gone by February. Stan's gone next week. Stan Fischer is gone. He announced his retirement last month, but actually was effective, I think, mid-October. So he'll be gone in a couple of weeks. Janet Yellen will be gone in January. There were already 2 other vacancies on the board. Actually 3. So you're going to have by January, you're going to have only 2 members of the board, current members of the board still around, as Jay Powell and Lael Brainerd. So Trump is going to get 5 appointments, counting Fisher, Yellen, and the others who have left where they haven't even filled the seats yet. There is one name nominated, Randy Quarles, who's been nominated as vice chair for regulation, but he won't have a big impact on monetary policy because he's the regulatory guy. He'll just do whatever the chair wants in terms of monetary policy. So he's just a proxy vote for the chair, if you will. But we expect that Trump in the next couple of weeks will nominate Kevin Warsh as the chairman of the Federal Reserve. Of course, I've been saying that since last winter. We had this whole Gary Cohn boomlet over the course of the summer. All the big Washington insiders were saying it's going to be Gary Cohn. And I didn't see any way that Cohn would be chairman of the Fed, and I stuck to Warsh, and it looks like that's the way it's playing out. But they'll have sort of a package deal. They'll announce Warsh and two of the other vacancies who are names that where Warsh has at least had a voice, and who those people are. Kevin told the White House, I don't want to be chairman if you're going to fill up the other seats with a bunch of bozos, he didn't use that word, of course, but he wanted to make sure that the other seats would be filled with people that he could work with, so he wouldn't be chairman of a dysfunctional board. And the White House, engaged in that dialogue with him. I mean, Trump likes to be in charge. He doesn't like other people telling him what to do, but they were willing to work with Kevin in that regard. So we'll see like a package deal. I think 3 seats, counting Kevin Warsh as chair, announced probably before the end of October. Then the confirmation hearings will begin. Yellen will leave. And then we'll have one more vacancy to fill, and you'll see basically a whole new board by February.
Yeah, and the Senate, both parties in the Senate have been dragging their feet for confirmation. It's not just, Trump's Federal Reserve appointee, it's other Trump appointees are not getting through the process. Normally the process is pretty slow for a lot of cabinet member appointees, but it's slower than even normal. How often do you think central banks collude, talk about going into markets either with bond purchases or expanding balance sheets or exchange rate coordination? How do you think they're on the phone maybe coordinating this daily? Are they meeting in Basel, Switzerland every 6 to 8 weeks? What's your views on this?
All of the above. I mean, I don't know if they're on daily, but certainly the foreign currency swap lines, the monthly meetings at the Bank for International Settlements in Basel, Switzerland, other private calls go back and forth, and they affect not only interest rates but also exchange rates. And in fact, exchange rates have been a lot more volatile than other markets. You look at people say, where's the volatility in the stock market? Where's the volatility in interest rates? Well, you can see the volatility. It's in the foreign exchange markets. You go back 10 years, there have been 6 separate moves of 20% or more, averaging about 21% between the euro and the dollar. I mean, these are supposed to be the 2 leading reserve currencies in the world, and they're not the least bit stable against each other. There may be price stability in Europe of a kind and price stability in the United States, but there's no stability at all in terms of those 2 currencies. So that's just a question of, 2 thirsty people with 1 canteen. You pass the canteen back and forth. So in 2011, we had the all-time low for the dollar at a time when the dollar needed. So the U.S. economy needed a boost. The view was, hey, if the U.S. economy doesn't make it, the whole world's not going to make it. So we need a break. But by 2012, the view was the U.S. economy was strong enough to bear a stronger dollar. Now, that was a mistake, but that's the view the Fed took, and so we got a stronger dollar through 2012, 2013, 2014. The euro went from $1.60 all the way down to 1.03 at the low. A huge drop. This was meant to throw Europe a lifeline, and now more recently, Europe was seen to be a little bit stronger. Their growth was better, unemployment down, and so they said, well, okay, now we can have a stronger euro and we need a weaker dollar. So we saw the dollar going down all through 2016. That's one of the reasons gold went up. The dollar price of gold in some ways is just the reciprocal of the dollar index, except in the last 3 weeks, that has turned around. Based on this, Janet Yellen's speech on September 26th in her FOMC press conference, the markets formed the view, completely mistaken in my opinion, but the markets formed the view that the Fed was going to raise interest rates in December, and that has led to a strong dollar, weaker euro, weaker gold, weaker bond prices, higher interest rates scenario. That whole thing, which is prevalent today, I wouldn't fight it, but it's going to reverse violently as we get closer to December, and it becomes apparent that the Fed is not going to raise rates, and then all of a sudden you'll have the opposite. You'll have this whiplash effect where all of a sudden the dollar gets weaker, euro gets stronger, gold gets stronger. Bond prices rally, interest rates come down, but we're not quite there yet. The market's still entertaining the mistaken view that the Fed's going to tighten in December, which they're not.
I want to ask you now about gold demand. U.S. retail demand for gold and silver, based on the mint numbers and other anecdotal evidence from hearing from friends who have spoken with wholesalers and other retailer bullion dealers, has collapsed. I think sentiment is incredibly negative for American speculators or investors of gold and silver. What's your opinion then of physical gold demand in China and India? And are Swiss refiners still having problems sourcing large amounts of material?
Yeah, the United States is a bit of an exception. The U.S. doesn't seem to get gold. Whenever I call my gold dealer, he's kind of like I tease him. He's like the Maytag repairman sitting around waiting for the phone to ring. Yeah, I hear the same thing from U.S. gold dealers, that demand is really weak. That's not true around the world. I mean, China's buying as much gold as ever. Gold demand in India is up. Russia, through thick and thin. I mean, look at their reserves. Their reserves dropped from 500 billion to about 300 billion approximately, and yet during that entire 40% drawdown in the reserves, they kept buying gold. In other words, when they were losing reserves, they would sell treasury bills, they would sell euros, they would sell other things. But not only did they never sell gold, they kept buying gold. And Russia's gold reserves are now closing in on 2,000 tons, which is a lot of gold for an economy the size of Russia. So demand is strong. Mining output is flattish. Well, of course, what we had, in 2009, 10, 11, when the price of gold was soaring, everyone was opening gold mines and raising capital and doing feasibility studies and producing gold and all that. This is when gold was, $1,200, $1,300, $1,400 an ounce, and then it just crashed. The gold collapsed, the price collapsed in 2011. People were able to hang on for a while, but by 2013, let's say, a lot of those gold mines had either filed for bankruptcy or shut in production. Well, now, of course, with higher gold prices, I know they're down a little bit in the last couple of weeks, but gold is up significantly for the year. It's one of the best performing asset classes in 2017. I expect that strength will continue. So with that kind of strong gold pricing, the miners are kind of back. They're trying to reopen gold mines, but you can't do it on a dime. It takes 5-7 years sometimes to do new exploration and get the financing and the logistics and the feasibility and the environmental permits and everything you need. So it's going to be a long time before gold supply from the mines catches up. Meanwhile, gold demand is still very strong. The refiners are having trouble sourcing gold. A lot of the vaults are almost stripped bare. The COMEX vault's low. Gold continues to move from bank vaults to private vaults where it comes out of the floating supply. Central banks around the world continue to demand the repatriation of their gold, whether it's Germany or others. And so the global supply-demand situation is very tight. Not true in the United States. I think just Americans have been, whether it's miseducation or 40 years of being told that gold's a barbarous relic, or self-deception or propaganda, or I don't know what, but Americans don't get it, but they'll find out the hard way. They should.
I think it's also the gold and silver price manipulation that a lot of people who believe the stuff that we've discussed over the years, Jim, they just have given up. So they're giving up. They're chasing Bitcoin because they're like, Bitcoin's not manipulated. The chart looks good. So they're speculating on Bitcoin now, trying to replace the gains that they thought they were going to get in gold and silver. Now, I want to ask you about China. Kyle Bass says China has 40 trillion RMB in bad credit, bad loans. It's an enormous number. Obviously, I think they're going to need a bailout at some point in the near future. But there's a lot of people in the gold community saying China is going to go on a gold standard. I don't see how you can go on a gold standard and do a bailout like that. I've looked throughout history, and I don't see that's possible.
Well, it is possible, but one of the keys would be a hyper devaluation of the yuan. And that's really how Kyle's trading it. Kyle's right about the analysis about the debt to GDP ratio and the bad debt and the insolvency of the banking system. He's got all that right. And his bet is the way he expresses that view in the market. I mean, he's certainly a gold holder. He was instrumental in getting the University of Texas Investment Management Company to buy $500 million worth of gold. I've spoken to him a number of times, been down at his ranch, and he has some interesting stories to tell about that. But his bet is the Chinese yuan is going to devalue in a significant way, meaning 20 or 30%. And I expect that as well, but not yet. And the reason it hasn't happened yet is because in 2 weeks, mid-October, we have the Communist Party National Congress, the 19th Congress, starting I think October 18th or 19th. I think it's the 18th. And President Xi is going to be reappointed for a second 5-year term as president. But it's bigger than that because he's not only aiming at his own reappointment, which I think is a done deal, but wants to get his cronies on the standing committee of the Politburo and perhaps perpetuate himself even into a third term. So he's the most powerful Chinese ruler since Mao Zedong, and starts to look like Putin is almost the president for life. Well, ahead of that, the last thing he wanted was any upset. He didn't want to rock the boat. He didn't want a currency war with Trump. He didn't want to be called a currency manipulator. They closed the capital account. They raised interest rates. They propped up the yuan. They wouldn't allow any bad debts to be written off. So they did a lot of things to keep a lid on things, to keep from rocking the boat, as I say. But once the Congress is over and once the war with North Korea begins, China is going to be, all bets are off. At that point, she will be in a much much stronger position. And given all the problems, given the Mendelian trilemma of, how do you have an open capital account, an independent monetary policy, and a fixed exchange rate? And the answer is you can't. You can try, but you'll fail. 100% chance that you'll fail. The only question is how and when. Given that, they've got to square that circle somehow, and the easiest way to do it is to devalue the yuan. So I think that is coming, but not yet. That's probably early next year. I think Kyle's right in his analysis. As far as China's not going to go to a gold-backed currency. Nobody wants yuan. I mean, it's not. There's no rule of law. There's no yuan bond market. There's no place to put the money. If you had yuan, what would you do with it? I mean, there's no yuan bond market equivalent to the treasury market where you can go out and invest. But what they are working on is an SDR market, a special drawing right, where China would have a larger voice in the IMF. And even Lagarde this week gave a speech talking about using distributed ledger technology, which is just the newer name for the blockchain, to have a kind of a digital crypto SDR, make the IMF the clearinghouse for all digital virtual currencies. So that's a very interesting speech. People should read it to see how I'm not a big I think Bitcoin's a fraud, but that doesn't mean, but the technology is good. The distributed ledger technology, the platform on which Bitcoin was launched and other cryptocurrencies, that technology has a future. But states are going to take over the crypto space. They're going to run these private cryptos off the road and replace them with, a digital. I mean, the SDR, the dollar, euro, they're already digital cryptocurrencies. I mean, you might have a couple of bucks in your wallet, but that's not how you transact. You get paid. People wire money to your account. You use a credit card, use a debit card. People don't use cash. People don't even buy a cup of coffee with cash. So, and all that message traffic is encrypted. You don't send your name and address in a wire transfer without encryption. So I would say the dollar, the euro, the yen, and for that matter, the SDR, they already are digital cryptocurrencies. It's just that they have centralized ledgers instead of decentralized ledgers or distributed ledgers. And so that's what's new. Not the cryptocurrency part, and I think that will act as an accelerant in the rise of the SDR as a global reserve currency, and that's the threat to the dollar. It's not the yuan, it's certainly not the Russian ruble. It's the SDR.
So the SDR then would replace these large over-the-counter derivatives trades, how they use treasury bonds as collateral. So if the treasury bonds went bad, then the SDR would replace it as good collateral to re-liquefy this, tens of trillion dollar, up to a quadrillion dollar derivatives market then?
No, I mean, the treasuries won't go bad. They'll just, the Fed can always print money. The problem is inflation. You'll always be able to pay the treasury in dollars. It's just that the dollar won't be worth much. Because of the potential for inflation, but no, the SDR is just a form of money, and the IMF can crank it out and hand it to countries based on their membership quotas, and then they can swap them. It's kind of like that Chinese yuan deal where I said take my yuan, but oh, by the way, if you want to swap it for gold, you can do that. By the same token, if I hand out SDRs because I'm the IMF, the people who receive it might not want SDRs, but they'll be able to swap for dollars or sterling or Canadian dollars or anything they want, including Chinese yuan. But it's a way of, this SDRs will come to rest somewhere, probably on the People's Bank of China balance sheet. And then the question is, can you come up with a big enough SDR market to absorb that demand? And they're working on that. I mean, right now you can buy notes from the IMF in SDRs. The World Bank just did an SDR bond issue a little over a year ago. Standard Chartered did an SDR bond issue. It's slow, it's small, but they're working pretty diligently in that direction, and I think that will accelerate as some of these other crises come to pass, such as a war with North Korea.
And speaking of North Korea, I actually have a question about that. Why do you think China and the People's Bank of China would agree with the Trump administration and agree to put on large economic sanctions on North Korea?
Well, they don't want to, but they're not wild about the alternative. I think the Trump administration has made it clear to them that if you cannot help us put the squeeze on North Korea almost to the point of regime change, then we will go to war. And so if you don't want a war, you better help us. But I had lunch in Washington last week with a senior national security advisor to the Standing Committee of the Politburo, and she told me that the Chinese leadership thinks the U.S. is bluffing. And I said, well, that's pretty bad news, because the only way there won't be a war is if China believes we will attack and tries to help us prevent that by working towards regime change in North Korea. But as long as China thinks we're bluffing, then they're not going to do more than some token amounts, in which case that makes war more likely rather than less likely. So I think China's kind of between a rock and a hard place. They don't want trouble with North Korea. They don't want North Korea to open the borders. They don't want North Korean refugees, and they certainly don't want a reunified Korean peninsula with South Korean and U.S. influence right up to the Yalu River. On the other hand, they don't necessarily want a war either. So they're trying to balance the forces, but on balance, I think what they'll do is, let the U.S. do the dirty work, but then try to have a large hand in the reconstitution of the North Korean government under a new regime.
Yeah, this is an enormous mess that President Trump inherited. I mean, obviously it wasn't just Obama, but, Obama pretty much doing nothing for 8 years. This started, I think, with Bill Clinton, with the deal he gave them. But it looks like, Iran may have nukes in the near future soon, too. I heard a nuclear inspector say Iran doesn't have nukes yet. Well, they've been working a lot on ICBM technology, and I think they're planning on launching either non-nuclear missiles at Israel and Saudi Arabia in the near future. So there's a lot of, hot spots that Trump is inheriting here that are, he's going to take the blame for it, obviously, with the mainstream media, regardless of what he does, but it's not all his fault. He inherited just enormous messes from a foreign policy standpoint.
I think that's right.
Okay, I have one more question about China. So recently in the Financial Times, it seems that a lot of European Union corporations are getting angry with Chinese technology companies because there's a lot of acquisitions coming in. They're talking about putting in, restrictions on acquisitions, potential trade war. It looks like besides the U.S. and China, that was the large trade war that Trump has been talking about in his rhetoric, and China's been trying to stop that. Do you think we're going to see, a European Union trade war with China as well?
Well, the answer is yes. I would distinguish between a trade war on the one hand, and what you're talking about is really direct foreign investment, which is not the same as trade. But, there's a lot of wariness about Chinese direct foreign investment. Certainly in the United States, we're worried about theft of intellectual property, technology transfer, but also it's a little bit of a way of putting pressure on China to help us in North Korea. The Europeans have some of the same concerns, maybe not as many as the United States, about targeting some of these companies, but they certainly don't want the Chinese to target, national champions like airlines and utilities and major auto manufacturers and so forth in Europe. So I think that the Chinese will find that their opportunities are fairly limited for geopolitical and national security reasons. Trade war is a little different. That involves, tariffs and sanctions and countervailing duties and proceedings in the World Trade Organization. And the U.S. has been holding off on that because, we're ready to go. We're ready to very aggressively pursue a trade war, but we've been holding off because we're trying to get Chinese assistance in putting pressure on North Korea. But if Chinese don't do anything, which looks like they're doing very little, or it fails and we end up in a war anyway, then I think all bets are off. And at that point, there would be no incentive for the U.S. to go easy on China, and you would be in a much more challenging, much more difficult, aggressive trade war again by early to the middle of next year.
And I don't think anyone would win in a trade war. Maybe the automation and robotics companies, if everyone's costs are forced higher, those companies will just figure, we'll bring jobs back, we'll bring investment back into the United States, we'll build a factory, but instead of 500 workers, there will be 50 maintaining the robots and the automation, and that's it. Well, Jim, I have a few more questions for you. I'll have to ask you them another time. If our listeners want to follow more of your work, how do they do so?
Best way to do that, I'm active on Twitter at James G. Rickards. Also, my most recent book, The Road to Ruin, available on Amazon and bookstores, and also my newsletter, Strategic Intelligence from Agora Financial.
Okay, great. Well, thank you for your time, and I read your most recent book. Found it very interesting, and can't wait for the next one.
Thank you, Jason.
Wall Street for Main Street needs your help. Since the middle of 2016, YouTube continues to increasingly censor and sabotage the growth and success of my channel with dramatically slower or no subscriber growth, a huge decrease in views per month compared to 2016, and well over $10,000 lost in Google AdSense revenues the last 18 months. I should have been way over 20,000 subscribers and way over 3 million views last year, but it feels like I am Sisyphus trying to roll a heavier boulder with more and more additional weight up a steeper and steeper hill. In the last few weeks, all of my videos have been set to demonetization by default, and I have to manually protest each video. This is in addition to even lower than usual Google AdSense revenues after the adpocalypse started over a year ago for me. This has also affected my ability to get paid advertisers to agree to deals not involving YouTube, as I lost $3,000 per month in paid advertising deals at the end of June 2017 because all my analytics are down a lot thanks to YouTube censorship algorithms that have intentionally kneecapped the growth of my channel. With YouTube/Google/Alphabet /Don't Be Evil strongly considering demonetizing or setting all libertarian, conservative, or pro-Trump content to private to prevent any sharing or monetization, it is imperative I have a contingency plan to figure out how to make a living off my content. Each 30 to 40 minute video takes a few hours of my time before it's released to the public. There's a strong possibility that in the near future, YouTube will force me to move all or almost all my content to a new video upload website that allows free speech or behind a paywall on my own website. Thanks if you have already made a one-time or recurring monthly donation, and thanks in advance for any future donations as I decide the future of my channel and what to do with my content going forward. We accept one-time donations on the Wall Street for Main Street website via PayPal, Bitcoin, or Gold Money. You can also become a monthly Patreon contributor for $1 or more a month if you want to help me out. And don't forget to like each video on YouTube and share it with your friends and family if you think they would like the content.